Hey everyone, welcome back to Alpha Insights. I'm Ryan.
And I'm Jordan. Great to have you with us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
All right, today we're digging into NVDA, the chip maker that keeps dominating headlines. Short version, the company is the central play in the current AI compute cycle, but it also carries a very premium valuation.
Exactly. The data suggests NVIDIA has moved beyond being just a GPU maker. It's a platform business now, selling chips, software, and systems to cloud providers, enterprises, and researchers.
And when you look at the numbers from late April, the stock was trading around $208, and the market value briefly crossed about $5 trillion. That kind of scale changes how analysts and markets talk about the company.
Right. The headlines were loud, and they fed momentum across the semiconductor space. But beyond the headlines, what matters is whether data center demand and software monetization keep pace with those expectations.
So let's break it down. On the product side, the company still leads in high-performance GPUs used in data centers. Think of its H100 class accelerators, the CUDA ecosystem, DGX systems, and networking from the Mellanox acquisition. That hardware-software blend is a real moat.
Exactly. CUDA creates developer lock-in, and the company's software stack means customers aren't just buying chips, they're buying an integrated solution. Analysts note that switching costs are high for hyperscalers and research labs.
Which explains the margin expansion story. More revenue mix from software and high-end data center products tends to push gross margins up. The trailing earnings per share was around $4.90, for context.
But here's the counterpoint. Multiples are elevated. The price-to-earnings ratio sits around 42 times, forward P over E nearer the mid-30s, and price-to-sales is unusually high compared with peers, roughly 30 times versus peers in the single digits to mid-teens.
Yeah, that valuation pricing matters. The market is effectively betting that growth will stay strong for a long time. So any hit to revenue or margins, or even a cautious guidance line, could lead to sharp moves given the elevated beta.
Analysts broadly remain constructive. The consensus price target sits around $268, which implies about 29% upside from those late April levels. But targets span a wide range. Some are much higher, some much lower. So the narrative isn't unanimous.
And to be clear, that's market sentiment, not a recommendation. Analysts note the upside if execution continues, but they also flag the downside if demand normalizes or competition heats up.
Competition is the next piece. AMD and Intel are pushing into data center accelerators, and there's lots of innovation in alternative architectures. Plus, foundry dynamics matter. Taiwan semiconductor manufacturing is a critical supplier for advanced nodes, so supply and capacity are strategic issues.
Right. On the balance sheet front, the company looks conservative. Lots of liquidity, low leverage, and a high return on equity. Though part of that ROE has been boosted by share repurchases. That gives them flexibility for R&D and potential acquisitions if they want them.
Short reactions? Interesting.
Okay, earnings. The company reports later this month, after the market close, and that print will be the biggest near-term catalyst. Street estimates are high, and management historically gives conservative guidance and then beats when demand is strong.
So the questions on earnings day. Did hyperscalers keep spending? Are enterprises ramping AI projects? And was supply steady? If results show continued data center momentum and expanding software revenue, the market could treat this as confirmation of the bull case.
But the bear case is simple and real. Valuation is stretched. If demand normalizes, or if competitors take share and pricing power slips, multiples could compress quickly. Some analysts have downside scenarios in the low hundreds per share.
Right. So what should listeners watch between now and the print? 1. Pre-earnings analyst note revisions. 2. Any public hyperscaler commentary or big procurement announcements. 3. Macro cues like rate headlines that shift risk appetite.
Also keep an eye on technical levels. The stock was trading just under its year high in late April, and support levels are a useful reference because volatility is high. The beta is elevated, so swings can be material.
Final takeaways?
NVIDIA appears positioned to capture a disproportionate share of near-term AI upside, thanks to its hardware-software platform and hyperscaler relationships.
But valuation risk is real. The market is pricing in long-term growth, so execution and macro stability are key. Analysts note that the upcoming quarterly results will be a critical confirmation point.
Exactly. We're watching the earnings print and hyperscaler commentary closely. And don't forget, this is for informational purposes only, not personalized investment advice.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content.